in March, India announced 12% tariffs on steel imports targeting China and Vietnam. We were talking about this, my colleague and I. How have these import taxes helped, in a way, at JSW? And how are you going to reconcile that with entering or expanding into the Vietnam market? Because clearly there must be a market opportunity there. And how do we approach this tariff dilemma then?
Well, the safeguard duties which are implemented have helped. We have seen prices improving towards March, also in April, which is something one should expect going into Q1. We, JSW Steel, remain primarily a domestic producer. I mean, the capacity which we are creating is for India. The demand growth has been phenomenal, double-digit last 4 years in a row. So our focus primarily is India. We are not looking to, evaluate markets outside India. We do export, but that percentage also has come down over the last few quarters. Our focus is primarily India. We are building capacity for India, and we think there's going to be a market to absorb it.
Swayam, you believe that the core market is going to continue to be the primary focus area for JSW. We will be getting quarterly GDP at the end of the week. If demand is robust, phenomenal as you describe it, is it consistent with a headline growth rate of 6.5%?
It's very much so. If you see India as a country is in a phase called build phase, where country is, aiming to become a developed country by 2047. And any country going through this phase, you typically have a multiplication factor of 1.5 to 2 when it comes to steel consumption vis-a-vis GDP, which is what we see going into this year, FY26. There are a lot of positive headwinds. We see government capex going up to 11.2 trillion rupee. We see private capex picking up with interest rates coming down, credit availability in India. We also see a good monsoon, which will help with rural demand. So all of these positives makes us very confident about the fact that we'll be able to hold this growth rate in demand.
Can we bring in corporate activity? And Swayam, if we can just take a step back, and can we talk about the strategic and the commercial logic driving this planned acquisition of Bushan Power and Steel? And can you walk us through and help us understand why this takeover has been rejected?
Look, this matter is sub judice, and the decision has come from the highest judiciary body of India, Supreme Court. So I'm going to be restricting my comment. What I would want to tell you here is, we have implemented the resolution plan completely in compliance with law. We have brought this asset from a 2.7 million ton struggling steel mill to 4.5 million ton healthy company to the state at which it is today. We are in touch with our legal teams, and we are very confident that the remedies we have will help push our case, and we're going to proceed with that. But we remain very confident that it should improve from here as far as BPSL is concerned.
Any thoughts about the pricing environment over the next 6 to 12 months for your main product portfolio? And how are you managing the cost base, Swayam? How are you managing forex fluctuations? And ultimately, what does the outlook hold for consolidated margins moving forward?
So overall, the margin this year, starting with Q1 of FY26, we should expect to see an uptick in margin. Prices pretty much bottomed out in last 2 quarters, and we saw prices improving from end of February, early March, and then April. Apart from price, what you'll also see going into next year is the newly commissioned capacity of JBML, which was ramping up last year, would operate on full stream. That would also help bring costs down. We also expect other efficiencies as well as price-driven benefits, for example, coking coal, where we saw almost $50 reduction year over year. In quarter four, coking coal prices came down by about $15. And we have guided market that in quarter one, the prices should further improve by $10 to $15. A combination of this should translate into a better margin as we go into this year.
So it's interesting that you mentioned coking coal, and just give us a sense of where you are in terms of the transition and onboarding sustainable steel solutions and processes into the manufacturing line. And how is ultimately JSW managing this switch from coal-dependent blast furnaces to electric arc furnaces, EAF?
No, I'm glad that you asked. So we are the largest steel producer, and we believe that this size also comes with responsibility. In 2021, we raised our first sustainability-linked bonds. It was first in steel, any steel company globally, where we have committed that we will go from 2.4 tons of carbon dioxide per ton of crude steel to 1.95 by FY30. Last year, we also announced that we will become carbon neutral by 2050. Now, these two are, quite aggressive, ambitious goal, and there are clear plans which will help us get there. So, if I can use few examples, this quarter we will have 1 gigawatt of renewable energy commissioned. Another 1.4 gigawatt of renewable energy is under commissioning. So, by next 12 to 15 months, we will have 2.5 gigawatt of renewable powered supply, which is available to us. We have announced, potentially a low carbon emission steel making facility near Mumbai. It's a place called Salao. And, it'll essentially be electric arc furnace, which is, DRI based electric arc furnace, which will be, powered by renewable power. And it will be natural gas fired. This would take the total emission from 2.4 very significantly down to about 0.7.
Yes.
These are the building blocks. And, we are constantly working on. Our first goal is to get to 1.95. If I can share here, our internal goals are even more aggressive. And we want to become carbon neutral by 2050.